All right, well, welcome everyone to our webinar looking at the economic impact of the Federal Budget Reconciliation Bill, otherwise known as the One Big Beautiful Bill Act, the OBBBA. I am Chris Davis. I'm the Vice President of Public Policy here at the Connecticut Business and Industry Association. We're very excited to be hosting this event here today for you all in partnership with our CBIA Foundation, as well as with our partner Whittlesey, who will be going through a number of different aspects of this bill, its impact on our state's economy, our state budget, and importantly, our businesses here in the state. We're joined here today by Brenden Healy. He's a CPA and partner in charge of tax at Whittlesey. Brings over 25 years of public accounting experience, specializing in tax consulting for closely held businesses across a range of different industries here in the state, including manufacturing, distribution, retail, real estate, and also nonprofit organizations. He's an active member of both the AICPA and the Connecticut CPA Association. And Brenden has held several leadership roles, including member of the CTCPA Board of Directors. In addition to his professional commitments, he is a dedicated educator and community advocate, serving as an adjunct faculty and treasurer for multiple nonprofit organizations. So we thank you, Brenden, for joining us here today.
Thank you.
And we're also joined by Dustin Nord. He is the director of the CBIA Foundation for Economic Growth and Opportunity, which is a 501c3 that was started up just a couple of years ago here at CBIA, focused on long-term economic growth and strategies for the state of Connecticut. Dustin leads the foundation's efforts to drive economic competitiveness through the implementation of the Opportunity Connecticut plan, which is the foundation's economic action plan that was released just last year. And prior to joining the CBI Foundation, Dustin was a senior research associate at Advanced CT, the economic development organization for the state of Connecticut, and is a expert on economics and the Connecticut economy. So we are going to be going through a number of different portions of the bill here today and kind of talking about its impact as we go through. This recording will be made and sent out to all of the participants very soon after this takes place, within the next couple of days. We'll also be posting a version of this on our website probably within the next 2 weeks. So please be mindful of that in your questions. And when we have questions, feel free to fill them in the question and answer section of Zoom here. Type them in. If we can get to them during the slide, we will, but we'll probably be looking to get to most of the questions at the end after the presentation portion. And we'll be going through a lot of different topics, so we want to make sure we hit them all before we move on to a lot of the questions that we anticipate receiving here today. So with that, we'll start getting into the presentation. So we're going to be looking at both the economic benefits and potential drags on the economy presented by the reconciliation bill that was signed into law on July 4th. We'll be covering the tax cuts that were included in there for both individuals and for businesses, the business investment incentives, as well as the federal incentives in certain industries here in the state of Connecticut. Then we'll also be looking at some of the benefit cuts and the reduced spending that was included in the reconciliation bill and how that impacts the economy here in Connecticut, as well as higher borrowing costs that could come from the increased debt that is created by the bill, and then what ultimately will lead to state budget uncertainty. And it's a lot of things are being worked out right now. We'll cover those topics about the impact on our state budget as well. So first, let's start with the great opportunities that are presented by the passage of this bill. And Dustin, I'll kick it off to you to kind of talk about some of the high-level tax cut incentives that are presented in this bill.
Absolutely. Thanks, Chris. Excited to be here and talking about this. So I think many of us have heard about many of the initial good tax cuts that are probably stimulus tax cuts that we're talking about here, especially to the state of Connecticut. So a couple of the ones that stand out are the SALT cap increase. So that's state and local tax deduction for those that are itemizing their deductions, increasing from $10,000 to $40,000. Obviously, in Connecticut, that is a pretty big deal comparatively to a lot of other states, simply because we have both high state and local taxes and high incomes. And so the overlap of individuals who are most likely to take advantage of the SALT cap increase in Connecticut is definitely disproportionate compared to the rest of the nation overall. So when it comes to the Connecticut economy and our overall competitiveness, I would say that the SALT cap increase will definitely be a stimulus, and it definitely be more important to us than other regions of the U.S. overall. Um, the only downside being that it's temporary. So this does expire in a couple of years. So this could present a challenge down the road. But in the meantime, there are about 10-11% of people that filers in the state of Connecticut that fully use the SALT cap currently at the 10,000 level. So we would expect some of those individuals to take advantage of the much higher tax or much higher SALT cap that we have going forward for the next few tax years. Um, Ultimately, that just means more spending available in the economy, especially in places like southwestern Connecticut, where a lot of those higher income individuals reside. So that could be a boon for some of those areas. On the other side, for a lot of the other workers in the economy, that's the things we've heard about in regards to no tax on tips, no tax on overtime. Now, ultimately, when the Senate bill came out, there were caps on both of those in terms of how much could be taken in both instances, and I'll let Brenden get into that in a moment. But the overall impact will be that for some of these lower income, especially in things like tipped work, overtime work, these are definitely more middle income to lower income workers. Those are people that are spending a majority of their money. So this definitely has a stimulus effect for those individuals taking advantage of it. Same with auto loans. Those are individuals, again, that's probably more, this is geared towards new autos that are produced in the United States primarily. So it is a much smaller segment than what was originally proposed, which was on all auto loans. This is going to be a much smaller and more targeted tax credit. But for those that are purchasing American new cars under that fit within the various stipulations in the bill, again, that provides some extra pocket money and some extra opportunities for spending for those households. And then finally, on the seniors, it does provide new tax credit for seniors or tax deduction for seniors. Connecticut is not the oldest by any means in the state. We have about 19% of our population is 65 or over that would be able to take advantage of that. But it is, again, for those individuals, many of those on fixed incomes, that does present an opportunity for them to spend more money. Now, one thing to keep in mind as it relates to that particular stipulation, that particular change, is that it does have a phase out for people making over 150K for that level. So in some of those higher income senior households won't be able to take full advantage of that credit. So in a higher income state like Connecticut, we might see a blunting somewhat of that particular change.
Now, Brenden, let's dive into some of these specific changes here. We'll start with the SALT cap deduction and what that looks like for filers.
Yeah, and so as we all know, the devil's in the details, and so a lot of these are great, either permanent or temporary changes, but the SALT increase, and again, Dustin said it. If you, when you file your taxes, you add up all your income and then you take a deduction against those taxes, either your itemized deductions or you get a free standard deduction from the IRS, and we'll talk about those a little bit. But if you itemize, which is generally medical expenses, charitable contributions, and state and local taxes, the SALT taxes, if you itemize, you can now potentially take the $10,000 cap, which includes your property taxes on your house, your car taxes, your state income taxes, add all those together, and you think you're getting a big deduction, but it's limited to $10,000. In the past, now that $10,000 cap has grown to $40,000, which sounds great, and it probably is for a number of taxpayers. However, if your income is at $500,000 joint filing or $250,000 single filing, that cap comes back down again, such that as your income increases, the benefit decreases. And so, unfortunately, the higher earning taxpayers in Connecticut are not going to see the benefit of that SALT cap. And on top of that, as Dustin mentioned, it's a temporary change. So after 2029, that $40,000 cap drops back down to $10,000 for everybody. So it's nice, and it's going to certainly save folks some taxes, but not everybody.
And Brenden, in that point, the situation with the SALT cap, that can be used by individual taxpayers that get W-2s, as well as individuals that get paid through either 1099s or through their business income. This isn't limited to just small business owners or just individual filers through W-2, correct?
Correct. It's a personal income tax deduction. If you have a business, there's some other things that are a little more nuanced. But you're right. This is available to anyone that files a tax return, an individual tax return.
And some of those temporary deductions that Dustin mentioned,
Yeah.
this gets into the details here. What are some of those details?
Yeah. So now this is the no tax on tips that we heard about in the campaign. So some tips are going to get taxed. So let's just say that out loud. There's a new deduction for tip income. And again, just like most things in the tax law, as you make more money, you lose the benefit of the tax, the tax rule. So as we write here, a single taxpayer at 150,000 of MAGI, modified adjusted gross income, which is a fancy way of saying it's basically your income added together. So if my income is 150 and I'm single taxpayer or $300,000 joint filer, then this benefit phases out. The third bullet point is important because it applies to essentially folks in the typical tipping the tipping industries. So Brenden the accountant can't start getting or claiming tips on my tax return and expect to be able to take this deduction because that's not the intent. The IRS is supposed to publish more detailed guidance, and we're waiting for that because this law is so new. But in general, it's going to be in the restaurant industry, the hospitality industry, and those that are customarily accustomed to tips. In the fourth bullet point here is also important. In order to take this deduction, you have to report your tips. So it appears that the IRS is going to modify the annual W-2 form so that they'll have a spot to report the tips. And I suspect that the tip deduction is going to be based on those tips that employees are reporting. So, look, we should all report our income. We should all pay our tax, but we know from a practical standpoint, sometimes those cash tips might not make it into the tax record. So this is just a way for them to ensure they're giving you that deduction on the reported tips. And some of the other things, employers are responsible for withholding income tax and reporting on the tips. And as I mentioned, it's got to be reported on a tax form. So, and then the last point, this deduction is temporary for this year and a few more years.
And now, Dustin, the thought behind this too is putting some more money potentially in people's pockets after they file their taxes. Do we expect an economic benefit from this sector of the workforce being able to have that additional income?
I think that you would. I think that the challenge will be, to the extent, as Brenden just brought up, how many people that previously likely were not reporting their tips on their taxes will now benefit by reporting them because previously they weren't paying taxes on those tips, right? Because they weren't reporting them. So there is to the extent that it's a benefit, it's blunted by the fact that there are many people who likely were not putting those out there. It also potentially incentivizes certain employers in those industries that previously may have been paying salaries to move towards tips, right? Which ends up being a wash with regards to, in that respect, actually, that might be that would be a stimulus because you're lowering the effective tax rate for those employees, right? But largely speaking, again, it's not a complete replacement in that respect. It's sort of like a shift in terms of the tax burden there. So while there should be a stimulus there, it remains to be seen the size of that stimulus that would come from it.
Yeah, and one of the other benefits is that now it becomes reportable income too, right? So these individuals that may be at a lower income scale will now have a little boost there when they're going out looking for loans, looking for other opportunities like car loans and mortgages and things like that as well.
Mm-hmm.
that now they might bring it on books, as you guys mentioned, rather than, pocketing it and not paying taxes. They have a reason to put it on their taxable income now going forward, perhaps.
Mhm.
And let's talk about overtime, which impacts a lot of the industries here in the state of Connecticut, and what the impact will be on those individuals. Brenden, do you kind of want to go through some of those details?
Yeah, sure. And similar to other deductions, this is a temporary deduction, so it's available for this year, 25 through 28. It's you can so overtime pay up to $12,500 per taxpayer, so to speak, $25,000 on a joint return is the amount of the deduction. The second bullet point is important. It applies only to excess pay over the regular rate. So now we're still waiting for the IRS to provide guidance, but I believe this intends so if I get $20 an hour and I work 1 hour of overtime, so I'm paid time and a half. Let's say I'm paid $30 for that overtime. I get to include in my deduction not the $30 I earn, but the $10, the excess of overtime pay over my regular rate of pay. So this deduction might not be as exciting as we originally thought, but it's still a nice deduction. So it applies only to that excess pay over the regular rate of pay. There's, as most things, there's an income phase out. So as my income increases, I potentially lose this deduction. Overtime is still subject to the Social Security, Medicare, state taxes. That really hasn't changed. And again, the employers are responsible for withholding the taxes and reporting it properly. And we also suspect the IRS will add another box or another area on the W-2 to report this this amount for potential deduction. So it is it's a nice thing, and I think the right taxpayers are going to benefit from it, but not everybody.
And this is one where it's not limited to industry. It's not limited to private sector or public sector. It's available to all workers in our economy.
That's true. Yes. Yep.
And with that, Dustin, do we see the potential benefits from that? Maybe encouraging individuals to do those additional overtime. They increase that productivity within, I think of like our manufacturing sector, right? And a greater incentive for someone to take on a couple of extra hours, increase that productivity, or now additional money in their pocket, right? And the economic impact that could have.
Yeah, I mean, I think that's definitely true. I think there will definitely be a marginal benefit for the economy with respect to that. I mean, most workers don't earn overtime, so to the extent that this does encourage people to now earn overtime, some of that will be replacing work that would have been done that was not overtime, and some of it will be new. So there will be, won't be a straight like for like, increase in amount of work that people do. But I would imagine that I would expect this to increase the overall hours worked because of overtime. And in certain industries, I could definitely see that being a productive gain for those places. And again, it'll just be a matter of to the extent that these workers either work in one that's eligible for that overtime, that they have the hours available for that overtime. But in the instance that they are able to do that work, especially for the ones that already do it consistently, then this should be a boon in terms of the increased amount of consumption that you can get in the economy overall from those households.
And some of those other temporary deductions that Dustin mentioned earlier about the auto loan interests, obviously, when the bill got passed from the House to the Senate, significant changes there as to what qualifies for that interest deduction, and then also what seniors here in the state can see and expect to get in those deductions as well. Brenden, do you want to kind of go into a little bit more of those details?
Sure. Like everything else, there's some income phase outs to this. So on the auto loan interest, the potential deduction of $10,000 gets phased out as you make more money. $100,000 for single folks, $200,000 for joint filers. Interesting. If you're going to claim the deduction, you must include the VIN number of the vehicle in the tax return. So the IRS is likely going to do some checking. And we're also waiting for the IRS to kind of define which which autos will qualify. Dustin mentioned this earlier. There's some production related hooks into this rule. So I think the intention was for U.S. taxpayers to deduct interest on an auto loan for a U.S. produced vehicle. So we're waiting to get some more clarity on that. But it's a nice deduction. I wasn't practicing in the 70s and 80s, but I hear stories of deducting credit card and auto loan interest back in the good old days. So it's nice to see something comes around again. And then on the senior side, I think this senior deduction is the no tax on Social Security kind of thing. So I think this is what they intended for this. So there's a new deduction for taxpayers that are over 65. And again it phases out as well. 75,000 of income if you're single, or 150 joint. So you got to keep track of these phase outs. But likely we'll get some more guidance from the IRS on this as well. So, but it's a nice deduction.
And here in Connecticut, the state income tax also has similar deductions to what's being proposed here for that type of income as well, correct, for seniors?
They do, and the income phase out ranges are similar. They're not exact, but they're similar. So I don't know anyone that can do their tax return by hand these days in a pen and pencil, but God bless you if you can. But the software should be able to handle these.
Excellent. So let's dive into some of the business tax changes now as well that will undoubtedly have a direct impact on the economy and businesses here in the state. Dustin, you want to kind of hit some high level benefits that were included in the bill?
Yeah, I mean, I think one of the most exciting ones in terms of increasing investment, or at least trying to incentivize an increased investment, is the continuation and expansion of certain R&D expensing and bonus depreciation. So for that types of investment, on the R&D expensing side, Connecticut's one of the largest investors per employee in terms of private investment in industrial spaces. So our private companies invest a lot of money in terms of R&D. And that as this new law creates an incentive in terms of being able to do more of that. So I think we should be excited about that in the state of Connecticut with respect to supporting the existing industries that we have here. We think a lot about biotech, things like that, but a lot of our industrial giants do a lot of that R&D as well, and many of our small employers too are engaged in cutting edge work on research and development. So that should be a boon for R&D and continuing to grow that space in the economy. And then on the bonus depreciation, which Brenden will get into, he'll do a better job of explaining what that is than I can. But that just being able to incentivize and reduce tax bills for folks that are investing in the state is definitely a boom for those that are doing it. I think one of the challenges there for the state is that relative to a lot of, over the last few years, there's been a lot more industrial investment, a lot more investment in facilities and things like that. And a lot of that is passed over the Northeast due to our high costs, and especially around things like energy. So we might miss out on some of these types of bonus depreciation, some of the benefits of the bonus depreciation that other regions might get to experience a little bit more as a result of the lack of investment that we've seen in Connecticut in recent years. So if we can take advantage of it, I think that, that will be a lot of that will come down to whether or not we improve a lot of different policy areas within the state to allow businesses to invest in their facilities. But those are across sectors. So that just is a broad impact on the economy overall. On the pass-through entity side, a lot of our small businesses are pass-through entities, and so continuation of a lot of the stipulations that were in the Tax Cuts and Jobs Act in 2017. A lot of those continue. Some of them are expanded. So again, that side of for those that are filing as pass-through entities, this just continues to be a better opportunity for them to invest in their businesses, invest in themselves, and get the tax benefits as a result. So I would expect both of these things to continue to support local economies within Connecticut.
And Brenden, what are some of those investment incentives that Dustin just mentioned? Going into a little bit more detail about like how businesses can take advantage of some of these changes.
Yeah, sure. And if we think back, 5, 6, 7 years ago, maybe almost 8 years ago, there was this bill called the Tax Cut and Jobs Act, the TCJA, as we reference on the second bullet point. So the Tax Cuts and Jobs Act passed, I believe, in late 2017 and applied, most of it applied to 2018 and forward. So back then, a few years ago, we had 100% bonus depreciation, but it was being phased down by virtue of the law. The law said you can have 100% depreciation then, back in 2018, 19, but then it started to phase down down to zero. And what does that mean? All that means is it's a way to go out and buy a piece of equipment and then expense it right away. So under the normal tax rules, you buy a $100,000 piece of machinery, and then you have to depreciate that over time, and that's great, and you get depreciation deductions, and you save taxes over time. But it's nice to have an ability to completely expense something right away. So if I have to go out and buy it now, I'd love to write it off right now for tax purposes, and that way the tax savings will help essentially fund some of the cost. So we had bonus depreciation, it was phasing down, so limiting the amount of write-off we could take on those capital assets, and now it's back. So they implemented bonus depreciation they implemented 100% bonus depreciation for, and I want to point out the date, assets placed in service after January 19. Why January 19? Because January 20 was the inauguration of the new president. So January 20 and forward, you get the bonus depreciate, the 100% bonus depreciation, but not before that. So it's nice. It's nice to have that, and it's a nice benefit for a business owner investing capital in their company. And then Section 179 is another fancy way of expensing things, and that limit increased to 4.5 million. And all that means is I can write off $4.5 million of stuff as long as I haven't spent more than 4 million for the year. So if I have a huge capital outlay and I bought more than $4 million, the ability to take that Section 179 just gets reduced. But that's okay because we got the 100% bonus depreciation, which although there's some nuances in the definitions of what property qualifies for each of these, they're generally the same.
And with this, the state tax benefit for businesses, is it the same? Is it decoupled from what the federal schedule will be, or is it something that businesses can count on 100% depreciation right up front here in Connecticut as well?
Yeah, that's a great question and a great point. Connecticut has decoupled. We use the term decoupled when Connecticut law is different than federal law. So Connecticut many years ago said, we're not gonna let everyone take 100% write-off on this stuff. So you generally spread the Connecticut write-off over 4 years. It's still faster than what I shouldn't say. It's generally faster than what it would be. So it's a smaller benefit for Connecticut purposes, but Connecticut has decoupled from federal law. And so this is important. If you're planning for the year and you're going to spend a lot of money on some equipment or some capital improvements, you got to think about the Connecticut tax, because although you can write it off fully for federal purposes, generally Connecticut will spread that write-off over 4 years. So you might end up paying some Connecticut tax now.
And Dustin, how does that work with incentivizing these businesses to make those investments? I mean, are we anticipating this type of change to lead to greater investments in capital, either machinery, equipment, or actual physical plant for these businesses? Because of what Brenden just mentioned, that you still would have to pay the taxes here in Connecticut, could it disincentivize businesses to have multiple locations from doing it here in Connecticut versus doing it in a state that is coupled with the federal government that does 100% depreciation? Like, what are we anticipating from this change and its benefits to the economy?
I think that generally speaking, I would imagine you're right. I think it increases the amount that people will invest over time. I think that the bigger thing, arguably, is that it didn't change it to disincentivize investment. Obviously, this was phasing out over time, similar to some other things within the changes here. The real value is really just that it didn't disincentivize investment by allowing those types of tax changes to expire. So I think that, I don't expect this to create a huge boom in investment relative to what we've seen, simply because people, were this is just a continuation of what has been the status quo, largely speaking, for the last 8 years or so. But this allows for some of those folks to invest and continue to invest. But yeah, you're right. I think Connecticut's at relative disadvantage compared to other states if those states allow it. I'm not personally familiar with which states allow the full bonus depreciation, which ones don't. It's probably a mix depending on who's where and what they do. And to some extent, that's always the challenge with evaluating state taxes, as we talk about all the time, Chris. The ins and outs of it make it difficult to compare just Connecticut to the United States as a whole on something like this. But to individual states will probably be at a disadvantage to some and an advantage to others.
In the R&D expensing, as Dustin mentioned, Brenden, we have a lot of R&D expensing here in Connecticut, where state of innovation truly have been for a couple hundred years now. So, what are some of these details in the changes that were made, or the continuations that happen now from the TCGA?
Yeah, and this has been a hot topic in the tax arena for many years. So we talked about the Tax Cut and Jobs Act 7 years ago, and buried in that bill was this deferred, because it started, I believe, in 2022. This deferred rule that said, hey, even though you're spending money on R&D items, you're paying people to do R&D type of work. Oh, by the way, you're not allowed to deduct that for tax purposes right now. You have to capitalize those costs and then amortize those over time. What does that do? It's a revenue raiser for the government, in that they slow down tax deductions and spread them out over future tax years. So a lot of clients were frustrated in paying the tax, so to speak, on their R&D expenses because they weren't allowed to deduct them for the last couple of years. And it's been a hot topic in the tax legislation area. I will say, and I'm glad they changed it here in 2025, but Congress had passed and has been trying to pass a fix for this for many years. And I believe in 2024, correct me, I could be wrong, but so a few years ago, a bill had passed Congress. I think it passed the House, but died in the Senate, that would have fixed this. But whatever, bygones be bygones. We're now in a world where, going forward, generally, you don't have to capitalize R&D expenses, which is what the business community wanted from the get-go. Now, if I've been capitalizing those, I now have an asset that's carrying forward, and I'm deducting or taking these deductions over time. What do I do with that? Do I just keep going? Well, I can. But if I'm a small business, which is what they define as under $31 million of average gross receipts. So look at 22, 23, 24, add my revenues together, divide it by 3. If it's less than $31 million, then I'm a small business, and therefore I have a couple more options. So I could so for the R&D that has been capitalized and I'm amortizing that over time, I could go back and amend my 22, 23, or 24 return and take those deductions and then adjust it the way it should have been, in my opinion. So you can amend a tax return and presumably get some refunds of your tax dollars. Now, anyone that's practicing before the IRS these days knows that when you file an amended return, it takes an awful long time for them to process that return and issue a refund. So that may not be the most attractive option for small businesses. We know that because of the law, we know that 25 and forward, we can expense those items. So, and because not today, we're in 2025, and as a business or a business owner, I'm making quarterly estimates. September 15th is right around the corner, and that's my third quarter estimate. So as a business owner dealing with this research and development, maybe I'm not going to go back and amend. Maybe I'll just plan to expense it in 2025, and now I can reduce my third quarter estimate accordingly, and thus I get the benefit now versus having to amend with the IRS and wait 6, 9, 12 months for them to process the amended return. So that's kind of a little planning tip to think about. But anyways, it's great news. We're seeing taxpayers react positively to that. Certainly in the manufacturing space, it's a huge help for those businesses.
And Dustin, what do we think the impact of this will be, especially on those small manufacturers that might be really innovating here in Connecticut? Is it something that, will help encourage that further investment here in the state, or, something that will lead to perhaps attracting some businesses to move here to Connecticut and innovate here?
Yeah, I think Connecticut's definitely at a strategic advantage with respect to research and development, where we had the fifth highest in 2023, the most recent year for data in terms of the amount of R&D, industrial R&D spending that we were doing per employee, essentially. So relative to the size of our industries, we do a lot of research and development. I think we have a lot of the core competencies of doing that when it comes to our academic institutions and a lot of the industries that do exist here in advanced manufacturing. So I think that and in biotech, things like that. And so I think we are at an advantage. I think generally this improves the R&D, the overall R&D system in the U.S. overall. And as a result of Connecticut being a center for R&D, I think that generally we're going to be in a much better position than other states might be. And hopefully that will encourage further investment for those that are investing in R&D in the state currently.
And the benefits, as you mentioned, Brenden, are not just for this tax year, 2025, but if they so choose, if they think they could get some benefit to make, perhaps waiting for the refund to come, they could actually go back to as far back as 2022 to try to take advantage of some of this expensing.
Yep. And maybe 2025 is not a good of a year and they're not paying as much tax. Might as well go back and get the taxes that I did pay in prior years. So, yep, it's a nice option.
Very good. And so just a reminder to everyone, if you have any questions, please feel free to put it in the question and answer section here on Zoom. You can ask a detailed question. Brenden could certainly answer that one. If you have a more high level one, Dustin or I could give a shot at it as well. So feel free to put them in there. We'll try to get to them during the presentation, but if not, we'll get to them at the end. So let's talk about the qualified business income deduction and its benefits to the business owners here in the state.
Yep. So the QBI, qualified business income deduction, it's a 20% deduction that was introduced, I believe, during the Tax Cuts and Jobs Act 7 years ago. And what the theory behind that 20% deduction, and by the way, it applies to pass-through entities. So S corps, LLCs, partnerships, LLCs, taxes, those type of those pass-throughs. So it applies to pass-through income, and as we know, pass-through income passes through to the owner, and the owners pay taxes at their individual level, and the highest individual rate. At one time was about 39.7, 40%, but it's 37%. So the highest individual rate is 37%. However, under the Tax Cuts and Jobs Act, the C corporation tax rate, and a C corporation pays its own tax, that tax rate was lowered to 21%. So C corps are paying 21%, but an S corporation or a partnership LLC could effectively pay 37%, much higher rate of tax because it's taxed at the owner's level. And so what they did was they came up with this qualified business income deduction, which is a potential 20% deduction to essentially offset the income from the pass-through to kind of get it closer. It's not exact, but it gets it closer to the 21% rate. And so, and during the negotiations of this bill, we were watching this closely, and the 20% rate that is in existence, they had talked about, one draft had it at 23% of a deduction, but it's a 20% deduction. So the 20% deduction, the good news is it's made permanent. It was scheduled to expire, but it's permanent. And then there's a minimum amount, an inflation adjusted amount of $400 starting in 2025. Small benefit, but something. But at the end of the day, it's nice. They made it permanent and they tweaked some of the qualifications for specified trade or businesses. I won't get into those details, but they expanded it a little bit, but they made it permanent, which is great. It just helps the S corporation business get closer in the tax cost to a C corporation business.
And this deduction really can benefit even the smallest of businesses, correct, Brenden? Like, a single person shop, someone who has 2 or 3 employees, it's not something that has to be, a small manufacturer with 25 employees. It could be those startup companies, those entrepreneurs, the ones that, maybe do services, interior designers, architects, real estate agents, things like that can really benefit from this.
Yes, and that's a good point because it also applies to sole proprietors. So the smallest of businesses who maybe they haven't taken the time or they're not sure how their business is going to grow, they haven't become an S corporation or an LLC. The smallest of businesses can benefit from this as well. So it's nice.
And just know from my experience previously as a small business person, knowing that this was there, that seeing that impact happen when this originally got passed was a big benefit. And this should help those smaller businesses moving forward, knowing that it's a permanent one and not phasing out. So, Dustin, this is something that impacts about 120 to 125,000 businesses here in the state. What kind of benefit do we see from this being made permanent and something that small business owners can count on going forward?
Yeah, I mean, I think the consistency piece is right. That's a good thing to hit on because it does create that consistency, predictability that allows businesses to make investments, whether it's in new staff, new training, or new facilities, or just new investments in themselves in a way that is predictable and that they can count on this type of benefit being there for them. And again, yeah, you're right. There's, Connecticut's the land of small businesses. A lot of those businesses fall under this category, and it just provides more money in their pockets to make these kinds of investments. So, again, I think when we're thinking about how does Connecticut fare relative to other states, I think Connecticut probably fares better than other states. Again, just simply because of the makeup of Connecticut's business landscape is very much skewed to the smaller businesses as opposed to the larger ones that might benefit more substantially on a relative basis from a change like and an expansion of this particular stipulation in the tax code.
And I know when there was negotiations of the specifically kind of this section of the bill between the House and the Senate, and there were some discussions about penalizing states that have pass-through entities, in part because they have this deduction put in there, and the SALT changes as well. You mentioned it, but it's important to note that the final version of the bill did not penalize states like Connecticut that have pass-through entity taxes, correct? And it's something that these small businesses can continue to take advantage of to try to equalize that income tax rate going forward.
And that's a good point. And our last bullet point on the slide, Connecticut was one of the first states to introduce the pass-through entity tax, which essentially got around that SALT cap that we talked about earlier, the $10,000 SALT cap, which is now $40,000. But that $10,000 cap really hurt a lot of pass-through business owners because they weren't allowed to deduct the Connecticut taxes, the income taxes on their business profits. So it put them at a disadvantage. So I give Connecticut credit for passing this. And there's a lot of angst. The American Institute of CPAs was very concerned about the pass-through entity tax fix that had been drafted. But as you mentioned, Chris, those changes didn't make it in, which is a good thing. So Connecticut's pass-through entity tax is still here, and it benefits many business owners.
Excellent. So let's talk about some of the investments that were included in the One Big Beautiful Bill Act that could have a real direct impact on industries that are important to our economy here in Connecticut. Dustin, do you want to kind of cover some of those?
Yeah, sure. I think the big ones that stood out was there was a whole section talking about the increased investment in defense and shipbuilding. That was definitely a focus of when you look at some of the direct spending that was included in the bill. That was very clearly laid out in terms of increased spending, and a lot of that relates to industry that is particularly relevant to Connecticut. So, including 250 million in defense manufacturing and 450 million in maritime workforce development. Defense, Connecticut is one of the top recipients of defense contracts in the entire country. We have a very large share of manufacturers who are engaged in defense manufacturing. So, again, this $250 million sounds like a lot. It is spread over, the large country that we are, but it is not nothing. And it's definitely helpful for those businesses that are engaged in Connecticut. And again, something where Connecticut is definitely an advantage. Same with maritime workforce development. I think Connecticut is one of the largest as a percentage of our GDP, as a percentage of our workforce. Shipbuilding is pretty important as a result of EB down in Groton. So uh, investment in that supply chain is something that an investment in the workforce development chain that we have here in the state can only benefit the further development of skills, the further increase of people being able to access high paying and well compensated positions in the maritime and shipbuilding industry. So I think that's a definitely positive improvement on that side of things. And again, I think it's still, to Brendan's point about waiting for guidance, I think they're still waiting for guidance as to how that money will be distributed. So it's too early to say exactly what kind of a windfall Connecticut businesses would see from it. But I think it's encouraging to see that this continues to be a priority for the federal government, investing in these industries that are pretty critical to Connecticut's economy. And on the affordable housing side, the big change was the expansion of the affordable low income housing tax credit and the amount of money that was available in that program. So being able to expand investment in affordable housing, I think, is important. We talk about it here at the foundation. We hear about it all the time from our employers that we need more housing in the state. We need it of all types in terms of for all types of incomes. But this provides an opportunity for us to build much needed affordable housing in Connecticut. And I think that, while it's an increase over what we've seen, and it will, there's still limits to what it can do. It's still always an improvement to see that increase of value that will be available for doing that type of construction.
Let's kind of dive into some of the affordable housing incentives. And I know we just got a question about this as well. Who it impacts, who can take advantage of it. Brenden, could you kind of dig into some of these details about the changes that were made to the credit allocations?
Yeah, sure. Yeah, let me talk about the credit, then we can answer the question as well. Can you please say this? So the affordable housing credit, let me just answer the question in the chat or in the Q&A. The low income housing credit is for the builder of the building. So you got to apply for it and you got to get granted, and it's a process, but you got to be the one either building the low income housing property or you're rehabbing, taking the existing building and rehabbing the property to meet certain standards. So it's the builder gets the credit. Well, I shouldn't say that. I shouldn't. It's complicated, and the owner of the building gets the credit, and a lot of times there's investors involved, but the tenant does not get the credit. Just to be clear. Anyways, back to these changes. So the low income housing tax credit, we call it LIHTC, low income housing tax credit. It's permanently increased. It went up by 12%. The allocation went up by 12% per state, which generally means it's a federal credit and it's allocated to projects within certain states, but they've increased that allocation. Good news. And it just opens up more opportunities for investors and I'll call it builders, but generally investors in low income housing deals to have more options and to spur investment into communities. So good news. The 4% credit was expanded. There's a 9% credit, which would be, I guess, the first bullet point, and that's generally when I'm building a building and building low income housing. And then 4% credits are generally rehab. So I've got an existing building, but I'm making it nice and rehabbing it. So there's different types of credits. But the 4% credit was expanded, and the private activity bond (PAB) threshold was reduced. And essentially, all that means is it just gives more flexibility to investors that want to invest in these projects, which is good news. We talked about bonus depreciation earlier, but bonus depreciation is nice with these low-income housing projects because certain things within the project could be accelerated for depreciation purposes if the investors want that, and it's it's another way to save taxes. And then the new markets credit, which is a similar type credit, it's different, but the concept is the same in that it spurs investment in maybe distressed areas in the state. But the new markets credit, it was a temporary credit, and you'd have to wait for the Congress to extend it, and they always extended it, but I think it created some uncertainty, certainly in the investor area. But it's permanently extended, which is great news, and I think the markets will react positively to that. And then there's some changes to that to kind of expand what the credit can do as well. So all good things. Some of it's nuanced, but it's good stuff. Good news.
And as you mentioned in this planning tip, it's gonna, get to the point of hopefully increasing the amount of affordable housing that's created or low income housing that's created by including it with the many state incentives that are in this space, the local incentives like, reduced or deferred property taxes really can help build out that capital stack that will allow for a lot of this housing to kind of pencil out, as they say in the building world, and have the ability to actually make it profitable for the builder to create this type of housing, correct?
Yep, well said.
And a place where this could be taken advantage of, perhaps, as well as other industries coming in, is the extension of the opportunity zones and some of the expansion that was included in that. That was in the original TCGA, created these opportunity zones across the country, certain census tracts in different states. Let's talk about some of the details that are involved in that, Brenden.
Yeah, so opportunity zones, as you alluded to, they were set up several years ago, and the intention was to spur investment into distressed areas in Hartford and Bridgeport and other areas that need help. And in the benefit of the opportunity zone was essentially I could, if I'm an investor and I have money to invest, I can invest that, and essentially down the road when that investment matures and I sell it, I don't have to pay capital gains tax. So it's a tax incentive for folks to invest money into certain areas, and you got to meet lots of criteria. But if I invest in this area, I can invest and presumably make money and not pay tax on it, and that's attractive to a number of investors. It also allowed let's say I sold my business or sold something and I have a big capital gain and I'm about to pay tax on it. Oh, gee, I can take that money and reinvest it into an opportunity zone type project and not pay tax on it that way. So again, the opportunity zones they're relatively new, but they're a great idea to give a tax incentive to investors to invest in certain areas. So what changed? The opportunity zones that existed, there's a big benefit up front, and then that benefit kind of waned out. And then the opportunity zone benefit was scheduled to go away. That's not the case anymore. Now it's permanently extended. Again, more good news. And then they're going to have a rolling 10-year designation period. So the U.S. Census Bureau is also going to work with now the governors of the state to nominate areas within their states that can qualify for opportunity zone credit or designation, I should say. The other thing is they've expanded the opportunity zone not only to be primarily urban zones, but now they're applying to rural zones. So I don't know this. I think maybe areas in eastern Connecticut might open up for rural opportunity zones. I'm hoping that. I don't know that. Certainly Midwest areas in the country that would not have qualified in the past will qualify. So it's a great incentive to attract investment, attract capital into areas that would not normally be as attractive, but for this 0% tax rate on capital gains. So it's nice.
And that's not industry specific, or are there limitations on what type of investments can be made in these opportunity
No,
zones?
not they're generally real estate and business type, trader business, but there's a lot of flexibility. There's a lot of flexibility in what they can do.
And this could also include housing as well, or are that separate?
Yeah, these are generally business type things, commercial real estate. So on the housing, you're generally looking at the low income housing credits.
Gotcha. And Dustin, a question that we got from someone watching is, is there a way of tracking this? Do we know the impact that the existing opportunity zones have had? Have there been a lot of investment in those areas? And, what could we expect? Brenden mentioned maybe now Eastern Connecticut, some of those older mill towns that qualify under opportunity zone. Do we see potential investment going there now?
Yeah, I mean, Connecticut DCD is the one that tends to track those projects. I'm not aware that they have done sort of a systematic tracking of those projects. I think that they, do report on specific ones that do come out, but I don't know of one specifically. There's a map where you can see which opportunity zones are available. There are 72 currently in the state. So there are a lot of different projects that have happened in those opportunity zones of a lot of different types and sizes. So hard to say the exact impact that each one of them has had. Although I will say the academic literature has been pretty positive with respect to opportunity zones in terms of their attraction of investment. I think they've generally been viewed as being successful in that respect. So a continuation of opportunity zones would definitely be value. And I agree. I think to that question, having a more robust deliverable in terms of how much each one of these opportunity zones have seen in terms of investment would be valuable. So something worth pointing out to DECD in the state to see what kind of resources they have. I believe they might have some of it. I just don't know if it's in like an easy to find and retrieve format, if that makes sense. In terms of, I think there's another question here about no state demographer having abolished position. Does Connecticut have capacity to identify qualifying tracks? I think absolutely. I mean, again, I think there's a research capacity at DECD to do that kind of work. And I think that's primarily who's done that kind of work in the past. I would expect them to continue to do that kind of work. And they were able to establish these to begin with, so I would expect them to be able to continue to establish them going forward.
And before we kind of jump into some of these challenges here, and it kind of is a segue to this because it will impact a number of nonprofits in the state, some of these challenges that are presented by the bill. But we got a couple questions about the impact on nonprofits, the impact that charitable donations will have. And Brenden, I know you practice with nonprofits often as well. What are some of your thoughts on the impact on nonprofit small businesses?
Yeah, so the big there's a question from Fred. Thank you. So going forward, there's a new, we'll call it a floor. There's a reduction in what you can donate or what you can deduct on your taxes for charitable contributions. So what does that mean? It's kind of like the medical deduction. So if I itemize my deductions, I first have to get over a certain floor and a certain dollar amount. And if I get over that dollar amount, then I can potentially deduct those. And so with this new tax bill, as Fred mentions in his credit, there's a 0.5% floor that you got to get over. So if I make $100,000 in the year, and 0.5% would be $500 if my math is correct. So there's a $500 floor. So any charitable donations, $500 or less, or said a different way, the first $500 of my charitable donations don't count. Anything above the $500 floor would potentially count if I itemized. And so to answer Fred's question, will we see a significant change in charitable contributions? I don't know. I don't know because back 7 years ago with the Tax Cut and Jobs Act, what Congress did was they gave everyone an increased standard deduction. So when you do your taxes, you add up all your income and then you take a big deduction against that. Either I take the big standard deduction, or I add up all my itemized deductions and I take the bigger deduction. For many taxpayers, um, many taxpayers just take the standard deduction now because it's high enough. It beats out the other stuff. And so we suspected back in 2018 when that first law changed it, that because of the increase in standard deduction, many people wouldn't be able to deduct on their taxes the charitable contributions, and therefore would we see a downturn? And I don't know that answer. We certainly talked about it, and I'm sure there was some effect in the economy in the nonprofit world. I just don't know. I don't know how big of an effect it was. So, getting back to Fred's current question, hey, with this new floor on charitable contributions, will that be a huge change or a huge impact to charitable to nonprofits? It might, but I don't. If I were to guess, which I shouldn't, but I'm gonna. If I were to guess, I would say no, it's not, because between us on this seminar, most people don't really understand the if I'm doing charitable contributions, I'm going to give my accountant, or I'm going to put into the software, the tax software, my charitable contributions, and then the accountant or the software is going to figure out which deduction is bigger, and they're going to take that bigger deduction and move on. So deep down inside, I think it's complicated enough that people don't really understand the fact that I would say most people don't pay attention to the fact that their charitable contributions might be limited, or will be limited going forward versus the standard deduction. So that's a long answer and probably too much information, but will it have an impact? Probably, but I don't think it's going to be a huge impact.
And Brenden, correct me if I'm wrong, but there was a change to allow, there's an automatic deduction for people that are filing a standard deduction as well, too, correct?
Yes, thank you. That's a great point. So for folks that choose the big standard deduction, the freebie deduction from the IRS, they choose that standard deduction. There's now an area to take, and it existed a few years ago. Then it expired. It's now back, and I forget the threshold. It might be up to $2,000. But even if you take that standard deduction, you get to deduct some of your charitable contributions, even though you're not itemizing. So it's a nice benefit. That's a good point, Dustin.
All right, so let's take a look at some of the challenges, things that could impact both for-profit and small businesses that are nonprofits as well. And Dustin, you want to kind of talk about some of the reductions in spending that could have an impact here in Connecticut?
Yeah, absolutely. I think when we're looking at some of the changes to spending policy at the federal level, I think we're looking at dollars into the state that might that ultimately supports economic activity. So the two big ones that many folks have probably heard about are cuts to Medicaid and cuts to SNAP. SNAP being the low-income food fund, so funding food opportunities for low-income families, as well as some other smaller services too. So what we might see over time is what we expect to see is a reduction in that federal money flowing into the state. For Medicaid, that estimate is about $13 billion over 10 years. It's hard to pin down exactly how many people we might expect to lose coverage as a result of, we're kind of estimating a lot of that is based on work requirements, which we can go into if you want, but it's complicated exactly how many people will lose their benefits as a result of those work requirements. But the big thing there on the Medicaid side that is worth monitoring is the impact that it has on healthcare providers and ultimately those that are insured in the state. If we have fewer people that are insured that are getting uncompensated, or if the employers, hospitals are providing uncompensated care, those costs do shift to somebody, and that somebody will likely be the insured population who receives those services from those medical providers. So that is something to monitor going forward in terms of what the ultimate impact is on rates. I think we hear from businesses all the time that that's still one of the biggest challenges they face is being able to provide health insurance at an affordable rate for their employees. And it's not clear that this will do much to help. I think this probably will be a negative on those prices. And ultimately, that's less money that people have to spend. That's less money that that businesses have to invest. They're having to invest more in health insurance rather than in other types of investment in their businesses. And so that might have a negative impact on overall economic activity in the state. On SNAP, I think, while the numbers in terms of the amount that gets cut is smaller, it's not negligible. And, a dollar into SNAP is a dollar spent. You don't get it if you don't spend it. So that money not being spent is money that's not being, put into the economy overall. It tends to have a positive multiplier on the economy. We're looking, when people estimate it, it's one and a half to one is kind of what you're looking at in terms of dollar for dollar, what the impact is on the local economy when people spend those SNAP funds. And so a reduction in that funding does mean less money in local economies. That does impact small businesses. You're talking about a lot of small businesses, in addition to the larger grocery chains, for example, that take EBT cards when people do use SNAP benefits. And it does impact a fairly large number of people. It doesn't mean that 400,000 participants doesn't mean that those people lose their benefits. It's just a reduction in what those benefits are. And we'll get into it in a minute, but there are some changes to SNAP in terms of how they're calculating the amount that the federal government will cover going forward. And that might impact the state budget, but we'll get to that in a minute.
So with that healthcare focus that you mentioned and the changes to Medicaid, what you mentioned the uncompensated care, that price shift, but what about the ACA marketplace and the increases there, Dustin? The impact that it could have on there, and then Brenden, what do you see for the impact on people's tax credits that they had eligible under the ACA?
On the premium side for the ACA marketplace, there are changes to the credits or what's available in terms of subsidy for people on that marketplace. And so those premium increases probably will result in some people losing health insurance, right? So because it's simply out of not being able to afford it anymore. And for those that do afford it, it just means a reduced disposable income after those types of benefit changes, right? So that was a federal offset of an expense, and now that expense is on the household books, and so that is just less money that those households that previously the federal government was spending in the state that now the households are having to spend. So that is to the detriment of the state economy. In terms of how that impacts Connecticut compared to other places, I'm not entirely clear. I think Connecticut, again, we do have a robust ACA marketplace. I think they've done a lot of work in terms of making sure that ours is robust. So it is a challenge on that respect in terms of continuing to maintain that marketplace. But we want to make sure that we're monitoring that going forward to see how many people ultimately might lose coverage. And again, same thing with Medicaid. Fewer insured people does put more of a burden on providers and the insured population to cover those costs.
Yeah, and on the tax side, I don't know that we'll see much impact. And I'm not an expert in this area, so this is my personal opinion. But I'm guessing that most folks, that dip into the marketplace, the ACA marketplace, might be in a bracket where they're not going to benefit from some of the tax incentives. So if I pay little to no tax, then oftentimes I don't get a tax benefit. So I'm guessing, and again, this is a wild guess. I'm guessing from a tax standpoint, we're not going to see much impact here.
Just to answer Fred's question in terms of the impact on the layoffs and closures at hospitals, I think it's too early to tell what that might look like. I think there will almost certainly be an employment impact simply because there's less money available. That being said, it's a growing part of our economy, so you are somewhat offsetting some of that growth. So to say that there will be layoffs necessarily, I think would be premature, but you might see a reduced growth. Ultimately, again, I think to that point, the potential impact is what some people have put it into thousands of jobs over a 10-year period is really what you're looking at. And when you're thinking about billions of dollars in terms of spending changes, I think that probably makes sense. So you are looking at one of the larger employment sectors in the state having to make up for billions of dollars in lost funding, and ultimately that does mean fewer jobs available. But whether that means a reduced employment overall or just less growth, I think remains to be seen.
And we'll get to the some of the energy changes real quick and the changes to higher education and the impact on workforce development in a moment. I know we only have about 20 minutes, 19 minutes left. So Brenden, I wanted you to be able to hit on the paid family medical leave changes though, because for employers, this could be something important for them to be tracking.
Yeah, so the paid family medical leave, PFMLA or PFML, that there's a tax credit for employers, and the new law expanded it to claim not only a portion of the family leave insurance premiums. Well, it did expand to include a portion of the insurance premiums, not just wages. So in the old credit, it was really just wage costs. Now it's expanding to include the insurance premiums, which is a nice incentive for businesses that take advantage of this. And then there's some other rules, but one of them is it lowers the minimum employee work requirement from 1 year to 6 months. So essentially making more employees eligible, which means the employer can take the credit. So it's again something good for business owners.
So let's talk about some of those energy changes that were made. There was a number of them in the bill, and an important sector here in Connecticut. Connecticut's invested a lot of time and money. We hear about the public benefits charge on our electric bills quite a bit over the last year, and a lot of those fund a lot of these types of services performed by businesses across the state. So Brenden, if you can kind of talk about some of these changes that were included on the energy sector.
Yeah, it will. And guys, feel free to interrupt me, but because there's a number of the next several slides. This law really affected the clean energy incentives. It really did. On this first slide, the energy efficient home improvement credit. And it wasn't a huge amount of money, but it was nice. If you get new windows, doors, skylights, you get an energy audit. You can get I think maybe it's a $1,200 tax credit. So it's not gonna necessarily pay for all the windows, but it's a nice incentive. But it's gone after this year. It's gone. So if you're gonna do windows and doors in your house, try to get them done before December 31st to get the credit. The second bullet point, the residential clean energy credit, solar panels that go on the house, geothermal. So those credits also end in December 31st. And a number of these credits were scheduled to expire, 2032, 2034, because that's what Congress does. They pass an incentive, they schedule it for expiration. That way they can score it and their numbers don't look so bad. But those expirations have been drastically moved up to the end of this year with these and maybe a little bit more with some of the others that we'll go over. So if you're looking at clean energy incentives, we're sounding the alarm now. You gotta really look at it quickly because those incentives are going away. There was an alternative fuel vehicle refueling property credit. I believe that applies to if I'm going to put in a natural gas refilling station for my vehicles. That credit's going to end next year, about a year from now. The 179D, the second bullet point, we saw this apply to business owners building new buildings, energy efficient buildings. It applied to nonprofits and frankly, it even applied to municipalities where the municipality that doesn't pay tax could actually assign this deduction to certain contractors. So this was a large incentive, a large tax incentive, but this has been eliminated after June 30th next year. So we got about a year left on this. The same thing with the clean energy investment production credits. They're essentially they're getting phased out. And these credits were introduced, I think, under I forget the tax law, but under Biden's incentives to really to spur clean energy projects within the country. But they eliminated them. So watch the dates. clean energy, the clean vehicle credit. You could have gotten up to $7,500 for a new vehicle. This is the Tesla rift with President Trump. But so if you want the clean vehicle credit, you got to get it before September 30th of this year. And also there's income limits as well. So if you are thinking about getting an electric vehicle, look at you may not, even though they still offer the $7,500 credit up till September 30th, a lot of taxpayers didn't realize they were phased out of that anyway. So you got to look at that. But the same with the used clean vehicle credit. So the $7,500 was for a new one, and there's a used clean vehicle credit that's going away, and then the commercial vehicle credits as well going away. And these are going away quick. I was surprised how quickly they're eliminated.
Some of the changes to higher education, the impact that will have on investments towards higher education institutions.
Yeah, I think my reaction on this is that this is more I think that Congress wanted to go after large, wealthy institutions with large endowments, Yale, Harvard, we hear about on the news. So there was a flat tax of 1.4%, but now they have a tiered excise tax system, and it really focuses on like per student. It's almost like amount of endowment per student. So so that's the tiered structure. So as I have a finite amount of students, but as my endowment grows, so does my tax. So it's an interesting concept they've introduced. They've also there's also there's a excise tax on large endowments with rates up to 21%, which is 21% is the corporate tax rate. So if you have a C corp business, you've seen that tax rate before. It's a flat 21%, but they're applying this to private institution endowments. And this third bullet point is a nice benefit, though, where an employer can pay up to $5,250 per year towards an employee's student loans, and it's a tax-free benefit to the employee. So it's think of it as a retirement contribution for the employee, tax-free. So this is a tax-free benefit to employees that are burdened with student loan debt. So it's a nice thing for employers that they can elect to do. So,
and that kind of couples nicely with what Connecticut's tried to do over the last couple of years with a student loan credit on the state side as well for businesses that want to make that type of investment in their workforce.
Yeah, it's a nice pairing.
And Dustin, with this and the endowment tax, Yale would be one of the ones that's impacted. Obviously, a huge job creator in the New Haven area. The research that comes out of there. What kind of impact do we think this could potentially have, having less dollars available for some of those investments at the university at Yale? And then I think they may be the only one that qualifies at this point, but maybe there's some other endowments at some of the other universities that would qualify as well.
I do believe they're the only one that hits that top tier. I think a large proportion of the amount that they spend from their endowment does go towards research and development, supporting faculty on research. So it's a hit in terms of that development. A lot of the job growth in the biotech sector, when we look over the last 10 years, it's been primarily in research and development. And that's probably a lot of that has come out of the New Haven area. So I think we would expect a local impact in terms of the employment and investment in that space. On top of the fact that you've seen reduced, venture capital investment over the last few years, that's more of a national trend. So it's definitely a hard pill for that particular sector in that part of the state. So continuing to support things like the R&D tax credit in Connecticut, I think, is important to try to offset some of the loss for some of these private businesses that you might be seeing in that part of the state. And so I think but it's definitely a challenge for those folks. Yeah.
And let's just briefly, we got about 10 minutes left, talk about the impact on the actual state budget of some of these changes that are being made, and on the federal budget for that matter. The changes in the interest rate really does add to deficit spending issues and the impact that it has on interest rates for not just borrowing by the state, borrowing by the feds, but also individuals borrowing.
Yeah.
Dustin, you could kind of hit upon some of these.
Yeah, I mean, there have been different estimates as to what the impact of increased deficits will have on overall interest rates, but I think suffice to say, we'll have upward pressure on those interest rates. So regardless of the exact numbers that you land on, it's definitely higher than it would have been absent a large increase in the deficits. The Yale Budget Lab put it at between, so in the near term, so for some of those near-term debts, you're looking at a 0.6 percentage point higher interest rate that people are paying, and over the long term, you're talking like 30 years, their estimates are more 1.2%. I think you take the long term with a grain of salt. You never really know what the future holds exactly, but in the near term, 0.5, 0.6% near-term increase in deficits or in interest rates is definitely a challenge for a lot of, on the state level, we have over $3 billion in annual payments that we make towards our interest payments every single year. Half a percentage point increase on the interest that we take in new bonds is definitely an expense. It means that it limits the amount that we can bond every single year in terms of what the impact is on our budget. And we rely on those bond funds in order to maintain capital programs, things like that, invest in infrastructure in schools, all sorts of in energy. So it's definitely a challenge for the state to have higher interest rates as a result of these new deficits. And on the business side, and also on the individual side, every single one of these is interconnected. So higher interest rates for the federal government means higher interest rates when you're taking out a loan on your house, when you're taking out a loan to start a business. Every single one of those is a disincentive in terms of investment in that regard. It's higher credit card interest rates. It's higher car interest rates on every single thing that you might buy with debt. And so there is a bit of a counterbalance that's created as a result of increased deficits. There's disagreement as to the extent to which this would, as they call, crowd out the impact of crowd out investment. It kind of depends on, we're going to stimulate the economy on one side, and then we're going to impact the economy negatively on the other. How those ultimately weigh out is anyone's best guess. But suffice to say that you can't just look at the bill as being strictly about increasing economic activity. There is a challenge with decreasing economic activity through reduced investment. And on the, again, on the state budget side, those types of how ultimately we implement some of these tax changes impacts the amount that Connecticut can receive in terms of taxation, how those ultimately come out in terms of IRS guidance will be important there. And then reduced reimbursements for things like SNAP and Medicaid is ultimately a challenge as well. We're a state that on the SNAP side, there's not much, we're going to continue to administer that program, and it just might be that it costs the state more money to administer it. On the Medicaid side, you're going to talk about increased investment in work requirements, trying to make sure that people on the compliance side there, and also increased investment in probably maintaining people's health insurance. Because again, it does have a negative impact on certain elements of the economy when you see a large number of people lose their health insurance. So there's probably going to be some onus on the state to try to mitigate some of that impact. And that in this last session, we saw an increase in business taxes when we saw business pressures. So when we're talking about how that looks for the future, I think it's worth monitoring if we have budget pressures going forward.
Especially looking at a potential special session either next month or the month after, where we're already, razor thin to that spending cap, right? These additional pressures, anywhere of tens of millions of dollars potentially in lost Medicaid payments could play a big role in decisions being made about those fiscal guardrails that, CBIA has been very supportive of maintaining. We have a few minutes left, and there was a question that came through that I just wanted to get Brendan's take on. Can you clarify that the paid family medical leave work requirement going from 1 year to 6 years or 6 months? Sorry, I think that was in regards to the federal tax credit that employers get. Correct.
Exactly. That's the federal, right? The Connecticut rule is a 3-month rule, but the federal rule is 6 months. No.
Great. We have a couple of moments. I know we talked briefly about the individual impacts. The impact on the state budget, are these going to be above the line deductions? Are these going to be below the line deductions? And the impact on state government, I think that's still kind of unknown. We're still waiting for some guidance on that, correct, Brenden?
Yeah, yes and no. So some things we do know if it's above the line or below the line. But we're certainly still waiting for guidance from the IRS, and some of it was allegedly supposed to be out 90 days from the passage of the bill. We'll wait and see if that happens. But certainly, though the guidance will be trickling out certainly for the next year. So we anxiously await from that.
So kind of summarizing here, just, changes the tax that, or extends the tax rates that were in the TCGA. We have those standard deductions that we went over earlier, and eliminates a lot of those personal exemptions that you mentioned. So it's really important for employers and employees to really be reviewing their withholding and estimated tax payments, especially coming up
Exactly.
here on September 15th, coming up so quickly
Yep.
here.
Exactly. So yeah.
And then with mortgage and home equity deductions, a big part of what people do on their taxes, quickly,
Yep.
what was changed there?
It just made this permanent. So in the old under the old rules, I could have $1 million of house debt plus another $100,000 of home equity debt. So I could deduct as below the line as an itemized deduction. I could deduct the interest on that debt. They changed the law temporarily. Now it's permanent. So I get two houses. I add up the debt on my home number one and home number two, not anymore. And I can only deduct the interest on the debt up to $750,000. So if I have two houses that I paid $1 million each for, sorry, I can only count $750,000 of that debt. And what is the interest on that debt? That's what I'm allowed to deduct. That's all.
And I know I'm from Northern Connecticut, so $750,000 house is a pretty big one. But looking at the southern part of our state, especially along the coastline, I mean that's a starter home for some families, unfortunately, at that price range. So this could have an impact on them as well.
Absolutely. Absolutely.
And then we covered a number of these, but a number of those personalized deductions were changed.
Yep. Limited, changed. Yep. Yeah. So you used to be able to deduct, your tax preparation fee, for instance. Those are gone. Some of the financial advisor fees, you used to be able to deduct them. Those are gone. Those are permanently gone. So this bill changed a lot of things. This last bullet point quickly, it really expanded the section, the 529 plan. So if you were fortunate enough to put money into a 529 plan to save for your child's education, they keep expanding. Well, it used to be just for college. Now it's the elementary and secondary schools. And you can take money out to cover books. So they're expanding what you can do. So it's a nice benefit. Alternative minimum tax. I don't want to talk about that, but a lot of taxpayers used to get hit by that, and now they're not going to get hit by it, which is good news. The big thing here, second bullet point, is the estate and gift tax. So the threshold is $15 million per person, so $30 million for a married couple. What does that mean? That means as I accumulate assets throughout my life, and assuming I'm not going crazy with gifting, I can accumulate up to $15 million for myself and $15 million for my spouse. And we can have $30 million and we can pass away and not pay any death tax to the federal or state government. So it's a nice benefit for business owners, for people that have amassed wealth. This $15 million threshold was scheduled to drop down to about $7 million if they did not act. But they've kept it up at this high rate. So essentially, wealthy families get to keep more wealth in their family. So it's good.
Yeah.
It's a benefit.
And this is an important decision in that kind of generational planning for small businesses, correct? I mean,
Absolutely.
this will be a big impact on that.
Big impact. And where do I live? Because Connecticut follows the federal threshold. And gee, do I move out of Connecticut? So it's a nice benefit.
And I know we've kind of, run up to the clock here. We covered a lot of ground. There was a lot here that we got to. I know there was a small change to the qualified business stock as well, change the ceiling there, increased assets. Those are things that if you fall under that bracket, I would highly recommend reaching out to Brenden, getting some more information on that one as well. I know it's kind of limited who that qualifies for, but it's important to small business owners.
Absolutely is. It's a great benefit. Yeah.
So feel free to reach out to Brenden after this. Any closing questions? I know we handled a lot of questions throughout the process here, but anything, any ways to get a hold of you, Brenden, maybe if you had some follow-up questions or,
Sure.
ideas?
Yeah, and I'm right on. I work for Whittlesey. I'm right on the website, so feel free to reach out to me. Yeah, be glad to answer any questions.
Dustin?
Yeah, you're welcome. Again, same here. I'm on the website here at CBIA, Foundation Director. I'd be happy to answer any things. I think this is a complicated bill that, especially on the economic side, we'll have to wait and see on how these things ultimately shake out. I think the questions have been right on, though. It's, there are benefits, there are, stimulus elements to this, and then there are things that we need to monitor how they ultimately impact people's incomes, people's jobs, and the overall economic environment.
So I want to thank everyone for tuning in here today. We covered a lot of ground. There was a lot of stuff in this bill, so I appreciate you sticking on to the end here. And we will get a copy of this out, recorded copy out to everyone who paid to be on this webinar here today. And then also we'll be posting on our website in about 2 weeks, kind of a wrap-up idea of what we covered here today as well. So I want to thank everybody for tuning in here today. And as always, if you have any questions, reach out to Whittlesey and Brenden in particular about some of these issues. We want to thank them very much for sponsoring today's webinar and taking part in it here with us. Thank you to Dustin and all that he does at the CBIA Foundation, putting out some outstanding economic research over the last couple of years. And thank all of you as CBIA members. And if you're not a member, please feel free to reach out to us. We'd be happy to talk to you about membership opportunities as well. So thank you guys very, very much. And thank you for tuning in today.
Thanks, everybody.
Thank you.